Hello and welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're interviewing Jody Gunsberg, who many of you know a little bit from past events and webinars. Jody is currently the Managing Director of CoinDesk Indices. However, many of you who have attended events and webinars in the past will recognize her name. She has been a speaker, moderator, and volunteer to CFA Society New York for years. But previously, she was a Managing Director and Chief Institutional Strategist at Morgan Stanley Wealth Management. Prior to Morgan Stanley, she was also with S&P Dow Jones Indices. So, Jody, thanks for being here. And it's great to see you in person again.
Thanks for having me.
As we are in recording this now in person. So I guess the thing that a lot of members would want to know is what was it like to jump from an analytical and complex financial oversight position from candidly a pretty cherry job to CoinDesk?
To me, indexing has always been a part of my 25 plus year career. And I think indices are one of the most underrated drivers of all investment performance. When I was on the buy side at the beginning of my career, the benchmark index constituents often served as the starting universe from which we pick stocks or bonds from as we overweighted and underweighted our holdings to outperform the benchmark. We also used the technical, fundamental, and industry group data in the indices for quantitative models to pick stocks. Then in consulting, we used indices as asset class proxies inside of asset allocation models. And we used the indices as benchmarks to measure manager performance. And I realized how hard it was for managers to consistently beat the benchmark. So I figured if I can't beat them, join them. So I spent almost a decade indexing with S&P Dow Jones Indices and learned how the advancements in data, technology, and financial innovation helps investors access a huge variety of strategies in a liquid, transparent, and cost-effective way. I took that knowledge over to Morgan Stanley, where I was the chief investment strategist for the institutional clients, that's 25 million and above, to help them allocate their fee budgets to pay for active management where it counts, like in fixed income, international equities, or even some illiquid alternatives. And after the pandemic crash, when many of our clients inquired about Bitcoin and crypto, I started learning more about it. And I used to program video games and casino games when I was in college, so the technology was right in my wheelhouse. And once I realized the value of the combination between cryptography and blockchain, I knew I needed to spend my career focusing on the innovation. And with my love of indexing, there was a great match with CoinDesk Indices.
Well, so a lot of people who work in and around the markets have had questions from their clients about investing in coin. What types of questions did the wealthy people that you were working with ask? Were they trying to achieve something with them, or was it more about finding a place for it in the long run?
I think that in the environment with overvalued stocks, rising interest rates, inflation, that everything seemed to be overvalued and people were looking for alternatives to park their money. So whether those alternatives were in private credit or illiquid hedge funds, these digital assets were another choice. And with the pandemic crash and the Fed putting so much more stimulus in, after the global financial crisis stimulus,
Right.
It brought a lot of attention to Bitcoin and digital assets. So they were looking for opportunities for returns, and they were also looking for diversification, inflation protection, and income.
I wonder if there were any skills that you acquired before or at the beginning of your time at CoinDesk. You mentioned you have a background in tech. But it sounds like the job is kind of similar in some respects. Or was there a quantum leap you made in Python?
To me, indexing is the buy side, short of trading. You're coming up with quantitative strategies. As long as you can build those quantitative strategies, which can get pretty complex again with the advancement in data, technology, and the financial innovation in order to turn them into products, the entire skill set required for the buy side in quantitative portfolio management is really put to the same use in building indices, only rather than trading, you stop short of at the strategy, license that strategy to the asset managers who then can put them into products to start trading. So as far as the skill set goes, I don't think that it took anything special to move from Morgan Stanley over.
Interesting. Okay. Well, so one of the things that I think a lot of members who are hearing these requests from their clients are a little bit struggling to understand, and this is why it's so interesting to interview you about this, because you are a real expert at asset allocation. Where do you think you slot digital assets into the asset allocation of any client?
That's a great question, because not all digital assets are the same. And of course, not all client portfolios are the same. One of the most interesting developments about the innovation in digital assets is how they fall into an asset class framework. And while there's no generally accepted definition of an asset class, one of the popular frameworks is of super asset classes that was put forth by Ibbotson and PIMCO a while back. And those frameworks define the asset class into capital assets. And those are things that like stocks, bonds, real estate, infrastructure, income producing.
Mm-hmm.
There's consumable or transformable assets. Those are like commodities that are used to produce other goods. And then there are the store of value assets. So things like currency, artwork, gold, and really until now, gold might have been one of the very few assets that could have spanned across two of those, which would have been the consumable, transformable assets like commodities or store of value.
Right.
Now, Bitcoin is a lot like digital gold.
Okay.
So you could maybe think about that as a store of value. However, Ether is a completely innovative asset. It's the first asset that we've seen that fits all three of those super asset classes. So the capital assets, owners of Ether own a piece of fees of the world's global settlement layer.
Yep.
For a consumable asset, Ether is a fuel. It's a digital commodity.
Okay.
For every computational step in Ethereum, a certain amount of Ether is burnt. And then it's a store of value because Ether can freely be traded or be used as collateral to borrow against in the digital economy. So that is a really difficult question to answer about where does it fit in an asset allocation, because we've never really seen an asset like this.
Right.
However, what I would lean back on as far as asset allocations go is it depends on what's the objective of the investment policy. And I think that that's something that we're all familiar with. So what's the type of digital assets that are being used? And what are the other guidelines that need to be considered? So, for example, different allocations are appropriate for different industries of digital assets, depending on whether investors are looking for inflation protection, income, or diversification. Also, various risk managed strategies can be used by global macro strategies, CTAs, or hedge funds with levels of allocation depending on where their target volatilities are.
Okay. So it sounds like what you're saying is that to some degree you can use these as an anchor to windward, as a way of risk mitigation through a diversification.
Absolutely. The portfolio framework, if you put into models, and that can be taken with a grain of salt because there's only so much data, but there is a full, at least 8 years of data of Bitcoin, is we do see higher returns. If you were to take 10% out of equities in a 60-40 stock bond allocation, move out of stocks into Bitcoin, for example, you would get a higher return, you would get a higher risk, but you would also get a higher Sharpe ratio.
Okay.
The Sharpe ratio would go up by about 0.4. So
it's
pretty significant.
Yeah.
And I think that from that perspective, yeah. Is it diversification to reduce your risk? It won't reduce your risk alone, but it will improve your risk-adjusted return.
Okay, fascinating. That's a really good way of putting it in perspective. So speaking of the risks, what do you think are the primary risks to digital assets in general, and how do you expect them to impact the asset classes?
The key drivers of crypto are influenced by three main risks. One is the market risk, and that's the risk that the adoption of the new technology from the market will impact the community. If you think about money and how community is important to the exchange of money, similar thing in the digital assets. There's a technology risk. That's pretty simple, but it's the risk that the underlying technology will break. So that's something to think about. And then the regulatory risk, that's the risk that receives the most attention, but its nuances are often poorly understood. And the need for regulatory clarity is important now for the right infrastructure to be built for compliance. So while many of these risks are common to other assets too, they're not unique to digital assets. We're seeing them exaggerated because of the emerging nature of these assets. And we can notice them in our risk models because they show up as very high volatility.
Okay.
And when we see that, I think that we would consider that the institutions and advisors that are using asset allocation software might be comfortable with looking at these numbers, but they have to remember that the timeframes are relatively short. So to take those results with the consideration that there's not full market cycles embedded in the analysis.
Okay. So just going back to one thing you just said about the we need more regulation so that or at least a better understanding of regulation so that the infrastructure can be built in a prudent way. Do you have a sense of how far we are from that? I mean, there's been a lot of talk about regulation, but not much has really hit the road. Rubber has hit the road yet. Are we far close? What do you say?
It's a process that's ongoing. The regulators are really actively trying to become more educated about the digital assets. Some of them behave like securities. Some of them are behaving like commodities. Some of them are behaving like currencies. So trying to understand what the assets are and which bodies should be regulating certain assets is an important exercise that they're sorting through. But I know that the institutional money is waiting on the sidelines, ready to go. It's just you need to know the rules of the game before you play.
Right.
So we need more clarity, and it's moving along. I think in the next couple of years we'll see a much clearer framework, but it's an ongoing process.
Okay, great. And going back to the risks you just outlined, how should an investor or someone with fiduciary responsibility seek to manage those risks?
There's two ways. One is on the industry. So what does the industry need to do to help manage the volatility? One is, again, we need regulatory clarity because we need to know these rules in order to play the game. We need better infrastructure for institutions to be compliant. We need the derivatives market and the banking services here in the US that support digital assets to strengthen and grow. And then these three things taken together will reduce the volatility. I think it will increase the confidence and accelerate the institutional adoption. But then there's the other side of managing the risks that falls on the investor. So what can the investor do? One is limit the investment and consider it speculative.
Okay.
Diversify into a basket of digital assets beyond Bitcoin. So start to diversify across digital assets, across industries that will help improve your risk-adjusted return. And then do your homework on the insides of the products, including the ones that have equities or derivative structures or single assets that might bring on more risk. And look for managed volatility product. You can actually find product out there that targets specific volatility. So if in your portfolio, maybe a 15 or a 20% volatility is all you can tolerate, then you might be able to get Bitcoin with a target volatility of 15 or 20%, and you can still get that diversification benefit. So I would look to learn from credible sources. And if the industry does what they need to do and investors do what they need to do, then I think that the volatility and the risks within the digital asset space can be better managed.
Wow, great. Perhaps we should leave it there, and maybe some of them will hear that we need to have all these things. But Jody, thanks so much. It's been so valuable to have someone with your insight into asset allocation talking about this very new sector.
Thank you for having me.